Hey everyone, it's been a while since we last talked on video, but I had someone talk to me today, or it wasn't today, it was 2 days ago, about how to be a great long-term investor, which I would say I run two portfolios in my free time, and one of them's, short-term trading, kind of for fun. It's more of a hobby. And in terms of my long-term portfolio, that's where I've really made money, and it requires a lot of patience. And that's the number one thing I say to people: it requires a lot of patience to be a long-term investor, and a lot of deferred gratification. And very few people have that gene. I think Charlie Munger said that one day. Um, so someone asked me what I exactly look for. Of course, there is companies that will obviously um, be worse than other companies and will be better than other companies. But what do I look for specifically for an investment that I might have for the bare minimum 10 years, right? That's my time horizon on the long term portfolio. It's 10 years. Okay. And number one, it's they have to have a moat, they have to have a competitive advantage. And these come in many forms. Some of my favorite holdings have been specifically in industries that seem unsexy or people don't think would be a good investment. My favorite, and I still own the company, just for a disclosure, and I'm not a financial advisor, don't take my advice, but which is Copart. It's a company that actually sells wrecked vehicles. So it's a pretty interesting company. Uh, they buy cars after hopefully, this never happens to you, crash a car. They buy the vehicle from the insurance company and they strip it for parts or they redo the car so it could be working again and they sell it on an auction site. Very unsexy business. No one graduates college and says, I want to start my own car selling business that is not really car selling. It's like buying used cars that have been destroyed. There's a ton of things that are just unsexy about it. There's actually a junkyard. Yes, they're junkyards here in Dayton where they deal with a lot of those cars. So I find an industry, it's a lot of a Peter Lynch kind of approach, finding an industry that doesn't seem like you could find good opportunities in it, but it really is. Um, Copart is up, I would say, at least a double from when I bought it years ago, and I love the company. I read the book called Junk to Gold, or it's yeah, Junk to Gold. Super interesting book by the founder, and that's leading me into my second point, which is management. You're looking for management that has a long-term attitude, and one thing I like to tell people is that no one has a long-term attitude unless they put their money where their mouth is. So you want the CEO, the owner, whoever's running the company to have skin in the game, to have incentive to be aligned with you as the shareholder. But number one, you don't want it just to be stock options. Stock options are basically you get paid at the end of each year in stock. We don't want it to be year to year performance for the manager. We want to be long term. So I look for companies that have a long history of the owner, CEO, whatever, owning a lot of the stock. So, for example, Copart, the owner's son now runs the business, I'm pretty sure. Last name Willis, I can't remember. It's not Bruce. And he owns a considerable amount of the company. Of course, he's sold some here and there, but it's obvious he's doing it just to like pay for things, like his daughter's college or something like that. So you want to make sure the owner has an owner attitude, making sure he has at least, I look for at least 10% ownership of the company. In some cases, I make flexible adjustments, which brings me to my third point, which is Taiwan Semiconductor, which is a company that I've recently added to the portfolio. I don't add very many companies to the long-term portfolio, so this is an interesting investment. And the owner, I forget his name. It's like Morris Chang. I'm pretty sure his name is. I can't remember. He founded the company. Pretty much upended Intel, which at the time looked indestructible, but he only has a 1% ownership. But the Taiwan government actually owns, I think it's a huge portion of Taiwan Semiconductor. So you can make adjustments, but you have to make sure that the owner is prevalent and not just has skin in the game, but also is passionate about what he does, about being there and running the company. That's the number one thing that Wall Street will never be able to quantify and will never get right, in my opinion. That's the reason why Berkshire Hathaway, for example, is always been undervalued. It's up over 100,000% since its IPO. Or I guess technically, yeah, its IPO was very long ago, but yes, its IPO. It always was undervalued because the market always underappreciated Buffett and Munger's ability to create shareholder value by creating deals, buying stock, whatever, because they never see that as a competitive advantage because they say, oh, they might have a track record, but they could still do something wrong. It's not a given that they'll do well in the future, and they were wrong every time. So figuring out the management of the company is the number one thing I look for, and the number one thing that can't be quantified and the biggest advantage. Next thing we look into is we want to make sure that the company is positioned to stay around for a while. I talked to a professor today, and I asked about a certain subject on which companies survive very long. And she said, of course, companies that have no debt survive very long. And I'm like, that's obvious to me, because it's hard to go out of business if you have no debt, right? And something else she said, which really kind of clicked with me, was something called the pecking order, which is something that was discovered, I think, in the 60s. I can't remember exactly who figured it out. But that companies that not only don't take out debt to finance their activities, but also don't take out equity debt or equity financing, and just use their retained earnings, so money they just get year in, year out from the business, and reinvest that only, actually stay around the longest. And it's kind of intuitive because people think, okay, little debt, of course you're going to be around longer, but equity financing it's not necessarily a liability to the company. So something that I've realized is that the number one thing is a company that reinvests their earnings, reinvests in themselves, because it's sustainable. It reminds me a lot of biology, a lot of Charles Darwin. I read a lot of books on Charles Darwin and how he relates to finance. Super interesting. And one of them is that every species likes to avoid type 1 error, which is basically thinking a conclusion is wrong when it's actually right. Okay? And how every species commits a lot of type 1 error. And a lot of businesses do that. But very many make a type 2 error, which is thinking that the conclusion is true when it's actually false, right? Taking out debt for a project when it's not a good one. Or taking equity financing out for a project when it's not a good one. So a company that uses their own earnings, it's kind of, the cash flows come in a very slow rate, or it gets slower than if you were to just take all the money out at once. So it makes you be a lot more prudent with your financing, and it also kind of just times you on your cash flows and how you want to invest back in the business. So interesting how the companies that do that typically stay around longer, even than companies that just take out no debt, but they just don't reinvest back in themselves. Simple and plain. So that's really interesting to me. The next thing I like to look at, which people think is very important, but it really isn't as important as people think, is valuation. And valuation, I'm reading a book right now, which I think it's behind me. It's called The Joys of Compounding by Gautam Bade. I hope I pronounced that right. And he talks about in the book how valuation is very simple, but it's not easy. People like to build these complex models, these complex DCF models to value a company, but really it's simple. A lot of valuation work that I do is building a model on the assumptions on the things I've already done. So a lot of the research I've done, finding the competitive advantage, the management, finding things about their balance sheet, etc. A lot of the research I've done on the company, why they make money, why they exist, will give me a good gauge on what they'll be growing at in the next 10 years, right? If they have a moat, they're going to grow, I hope. The management does a good job, and they have a good history of capital allocation. It's very likely they'll grow as well. So once I have an idea of all of the facts, I can create the assumptions. So what their growth rate is going to be. What, if I have a knowledge of the broader economy, what I think the discount rate should be. And all this stuff, it doesn't take very long. You can build a DCF model all day, right? But I like to keep it simple. There's two things that create shareholder gains. And those are the multiple, so the price to earnings ratio, or price to sales, whatever. I think it changes as you go along in the the growth of your business. First, you should be saying, price to sales, because sales is the most important thing. Then PE, and then price to book in other ways. But the major thing for me is that multiple is important because that's how the market expects and views the company. Okay. And then we have the earnings per share. So then we have the company, what they're residually making in and cash flows every year. These are the two things, the earnings and what the market perceives it at. So the earnings are the past performance, the PE or the multiple is the future performance that's predicted. Okay, I like to just try to create a model to create what I think the EPS is going to be. And I do the one thing first. I just project out all the expenses for the company, and then I get an EPS, and then I look what analysts are saying, and I go, okay, if I'm far off or in one direction, either high or low, I go, okay, what's my differing thing? And maybe I'll notice a mistake. And if I'm really close, I just go, okay, it's probably right what the analysts are saying. Not necessarily, but it's pretty likely. So what I look for is I look at my EPS, and I also will run the analysts what their average EPS is for, let's say, 10 years out, which some of them do have an EPS prediction 10 years out. And I go, okay, let's find a multiple. So the company's currently, let's say, trading at a 25 PE. Again, the PE times the EPS will give you the share price. Okay? They'll give you the share price. Once I find that, I have a 25 PE today, and I go, okay, 10 years from now, will this company still have this competitive advantage? Will they still be having the expectations of the market to hold a 10 or 20, 25 PE? And if I find that, and I go, okay, let's create a likelihood, let's say a 60% chance that they'll have a 25 PE. And I'll do the expected values, which expected values is probability times what you think what the PE is going to be. And let's just say I come out to a number, let's say a 20 PE. So it's 5 less than it is right now. So I times that 20 PE times my projected EPS, and boom, there's the share price. And it's projected 10 years out. And if you can't find analyst expectations for share price, the number one thing you need to look at is creating your own. So just find the EPS today and go, okay, what I think this is going to grow at on a compound annual growth rate. So for Copart, for example, when I looked at the company, I found that obviously they have a competitive advantage, right? There's some funny things. They don't have any competitor, or they had one competitor. Their name was Insurance Auto Auctions, and they went out of business 2 years ago, I'm pretty sure. Or they got bought out by Ritchie Bros, another company from Dayton. Second, they're the only one in the insurance auto auctions now, and they have a platform that everyone loves. The roommate is a car guy, a lot of people who are car guys, and they love this website. It's like all they care about. They have a network effects mode, meaning the more people use the software, the more people come in. It's almost like a flywheel effect, right? More and more people come. So think of Google, for example. More people that use the search engine, YouTube, whatever, the more people like using it as well. The more customers they brought in. Well, it's compounded in a way. So I noticed they had a competitive advantage. So do I think it's going to grow at 5%? No. And this is because I realize they can earn abnormal profits in their industry because they can keep competitors out. In economics we talk about a lot how you can't make profit because you have competitors that will come into your market once you make profit and take it away. But if there's no competitor, or you have a competitive advantage that's big enough to keep the competitors out, you're going to have an abnormal growth rate. Simple as that. So with Copart, I decided, okay, I want to do a 12% growth rate. I think on average, the U.S. corporation does 7. I did 12. And EPS can be manipulated a little bit. I did 12. And then I go, okay, what would it be if it was 10? And in the worst case scenario, I said 7. And even at that 7% growth rate, and a little bit lower in a PE ratio, meaning the market's going to perceive the company less in the next 10 years, I still came out with an abnormal return. I think at the time it was around a 12.5 per annum return, and that to me is satisfying enough because the market on average in a 10-year period will do 10% per year. So getting an extra 2% per year sounds great to me. It really did, even at that 7% growth rate. And I had someone ask me about Copart the other day. What does the market know or do not know that you do know? And I said, it's not that. It's the fact that I am willing to wait. The average holding period for a stock on, I think it's the New York Stock Exchange, is not even a week, I'm pretty sure, or it's like a few months. I'm willing to wait 10 years, right? And my rule is, if a thesis point is broken, so if the management, if the CEO gets kicked out, if the competitive advantage withers away, or the balance sheet gets different, I like to wait 2 years after the thesis point's broken, or a year. Sometimes if it's really obvious it's broken, I'm never quick to act. So I'm very slow to act with these things, and the market isn't. So I play that to my advantage. Second, no one likes talking about Copart all day, and that's another advantage. And I don't think the market's ever able to price a company 10 years from now, because the people are willing to wait only so long for returns. And I'm willing to wait forever. I have the deferred gratification gene. Not a lot of people have that. So that's why I am seeing the same stuff the market's seeing, but I'm just willing to wait longer. This is why Buffett did so well. He's held Coca-Cola stock for almost a century probably at this point, and hasn't sold. Simple as that. And he's made abnormal returns than the market. So that's that. At that 15% growth rate, which I think is what Copart actually achieved, probably a little bit less. I can't tell the number on the top of my head. They really found a way to do well and kind of enact on my thesis. And then I ended up achieving, I think it was almost a 20% return per year on Copart. And even this year, I don't even consider selling, even after making that much money or that much percentage return. I only wish I bought more, right? Of course, we always say that. But that's kind of my methodology on how to be a long-term investor. We think about, like active trading and short-term investing is this huge thing that's on a pedestal, but long-term investing is kind of the noble route. There's a Buffett quote I like where he says, the high road isn't crowded, so you'll be able to take the high road. And long-term investing requires a lot of humility and a lot of humanity to be able to do properly. So thank you guys for watching this video. I hope I gave a little bit of an insight to you guys on long-term investing. Feel free to give me a question or anything like that. I just thought, I was dressed up for something else, so I thought I'd sit down and record a video. Have a good rest of your day, guys. Cheers.